Jeffery. Joining us now is Piper Sandler Senior Research Analyst Jeff Harte to talk about where to from here, Jeff. And, a good month for banks and the rest of the financials. But, the last several months, let's say the last 6 months, it's been more sideways, kind of trading along with Treasury yields. So how is the setup right now? We've gotten the big buyback announcements from the huge banks. We know the credit situation looks relatively good. So how would you, position within the sector at this point?
I think that the path is still upward for bank stocks from here. I mean, you kind of, as you mentioned earlier, directionally they've been trading with the 10-year up a lot in the first quarter, gave it back in the second quarter. Now they're kind of moving back up again. But really, when I look at the banking environment and the outlook, you can kind of say the song remains the same, right? Credit's still really good. We're still waiting for loan growth. We think it'll happen, but we're still waiting for loan growth. Fee revenues, be they mortgage or capital markets, have been better than expected. Put against what are interest rates going to do and kind of, where do you go from here? The nice thing about the capital return stories, we've got the big buybacks announced and the dividends, et cetera, but the big buybacks do turn into a large price insensitive buyer in the market for a lot of these stocks. So not only is it, hey, it could be good for earnings, but it can also, when you're offsetting your top shareholder or two multiple times, that's a nice stable bid out there that's not going to be price sensitive.
What do you think is restraining the stocks or the valuations? I mean, obviously, we observe that it's trading with Treasury yields and maybe with expectations eventually for when the Fed might hike. But is that necessary? Does it always have to be the case? There's always, this chance that some other theme emerges that gets the group revalued.
Yeah, I mean, I think a couple of things that could happen to help revalue the group. And number one would be interest rates, and specifically short-term interest rates. If the Fed started hiking, and that implies the economy is good, that would help the bank stocks. But also loan growth. I mean, we've been watching kind of the pre-leading indicators of loan growth for most of the year, trending in the right direction, saying we should be seeing loan growth. And, I mean, loans have been stable, right? We're kind of seeing it, but we're not really seeing it pick up yet. Strong loan growth kind of in the back half of the year into next year, I think, would be a big thing to help push the bank stocks up from here.
Jeff, do you expect to see more consolidation in light of some of this recent outperformance? Do you expect to see, especially maybe in the asset management space, which has done its fair share of merger activity in recent years, do you expect them to see kind of a tailwind with this higher currency?
Yeah, I mean, I think when you're looking in the asset management space, there's still going to be a lot of consolidation, but also in the bank space, right? I mean, one of the areas we like in the banks is the universal banks, the big guys that have scale, because in a slower growth environment, scale really matters. Well, the offset to that is smaller banks are much more likely to kind of combine to get scale. So I think we'll see it kind of continue a lot of transaction in kind of, I think, both bank land, but also kind of specifically asset management. And it does seem in financials. I mean, fintech has really been the hot area people have been looking at least over the last couple of months. That's kind of been where a lot of the outperformance has come from. Some of the big banks like a B of A or JP Morgan are actually big players in that space as well. But, if we can get the attention turning back toward more traditional loan growth and supply demand things, that would be good for the bank stocks in general.
Shepard Smith here. Thanks for watching CNBC on YouTube.